Hello everyone, welcome to my course on capital investment. This is module 5 of this course. In this module we are covering capital budgeting cash flows. This is fourth lecture of this module. In this lecture we learn how to find out operating cash inflows. Now we need to know a few things about operating cash inflows. First of all, benefits expected to result from proposed capital expenditures must be calculated on a after-tax basis. This is because firm will not get any benefits from its investment until the firm satisfies government's tax claims. Then all benefits expected from a proposed project or machine must be measured on a cash flow basis. We know that cash inflows are the money that we have in our hand that we can spend. So cash inflows are not just the accounting profits. So we know that accounting profits cannot be or might not be spent, but cash inflows represents the money that can be spent. Then operating cash inflows requires adding depreciation and any other non-cash charges. We know that depreciation is a non-cash expense, and in the meantime non-cash charges like amortization are deducted as expenses on firm's income statement, but these are not cash expenses. So these non-cash expenses should be added while we calculate operating cash inflows. And the final step in determining operating cash inflows is to calculate incremental or relevant cash inflows. This is because our concern here is only the changes in operating cash inflows that result from the proposed project or machine. Now let's look at the Powell Corporation's revenue and expenses. Expenses are here excluding depreciation and interest for a proposed and present machine. So here is the first three columns are for proposed machine. So here is the revenues for the 5 years and expenses for the next 5 years. And the present machine and old machine will also generate revenues over the next 5 years, and it has expenses excluding depreciation and interest over the next 5 years. Now the proposed machine will be depreciated based on MECR's 5 years recovery period. So we know that if the recovery period of the machine is 5 years, we have to calculate the depreciation for 6 years. So if it is depreciated under MECR's 5 years recovery period, depreciation for the first year is 20%, then 32, 19, 12, 12, and finally 5% for the 6 years. And install cost of the proposed machine is $400,000. So based on the install cost and depreciation, the third row indicates the depreciation of the proposed machine over the next 6 years. Now the present machine was purchased 3 years back, so it has only the final 3 years of depreciation. So the present machine is also has a recovery period of 5 years under MECR's 5 years recovery period. It was purchased 3 years ago, and it has final 3 years of depreciation. So final 3 years of depreciation based on MECR's 5-year depreciation method is 12 years, 12% for the 4th year, 12% for the 5th year, and 5% for the 6-year depreciation. So based on this, uh, this row indicates the depreciation of the present machine over the next 3 years, and the last 3 years there will not be any depreciation. And the install cost of the present machine or old machine is $240,000. So based on the install cost and depreciation for the final 3 years, these are the depreciations of the present machine or old machine. Now let's look at the calculation of operating cash inflows using the income statement format. First, we need to know the revenues, then we have to deduct expenses excluding depreciation and interest, then we'll get earning before depreciation, interest and taxes, then we'll deduct depreciation. After deducting depreciation, we'll get earning before interest and taxes, then we deduct taxes based on the tax rate, then we'll get net operating profit after taxes, and finally we have to add depreciation or any other non-cash expenses. So once we add depreciation or any other non-cash expenses, we'll get operating cash inflows. So based on the income statement format to calculate operating cash inflows, here is the calculation of operating cash inflows for Powell Corporation's proposed machine. So we have already seen the revenues of Powell Corporation over the next 5 years, and these are the expenses. The second row is the expenses of Powell Corporation's proposed machine over the next 5 years. If we deduct expenses from revenue, we'll get earning before depreciation, interest and taxes for the proposed machine, and then we'll deduct depreciation. So in our previously we have calculated depreciation of the Powell Corporation's proposed machine for the 6th year. So here is the deduction of depreciation from earning before depreciation, interest and taxes over the next 6 years. So if you look at here, we are calculating operating cash inflows for the 6th year. This is because we have calculated depreciation for the present machine for the 6 years. Though there is no revenues or expenses in the year number 6, but still we have to count the depreciation which has been counted for year number 6. So if we deduct depreciation from earning before depreciation, interest and taxes, we'll get earning before interest and taxes. So here is the here is a negative earning before interest and taxes in year number 6 because there is no revenue, no expenses. So earning before depreciation, interest, taxes is 0. So if we deduct 20,000 from this 0, we'll get a negative 20,000 earning before interest and taxes. And the firm has a tax bracket of 40%. So based on this tax rate, we have to calculate amount of tax on earning before interest and taxes. So let's say, for example, taxes for the year number 1 is 56,000. This is 140,000 into 40%. So this is how taxes has been calculated over the 6 year period. So you'll find a negative tax. This is because for year number 6 there is a negative earning before interest and taxes, and this will save $8,000 in taxes on firm's operating income. As a result, there will be a net operating profit after taxes 12,000. So 20,000, with this 20,000 negative earning before interest and taxes, we have to adjust taxes, which is 8,000 on this 20,000, then we'll get minus 12,000 net operating profit after taxes for year number 6. Then uh, we are adding depreciation here for the over the next 6 years, and finally we'll receive operating cash inflows for the proposed machine over the next 6 years. So here is the operating cash inflows for the present machine or old machine. So we have already seen the revenues for the present machine over the next 5 years. Then we are deducting expenses of the present machine over the next 5 years. Then we are getting earning before depreciation, interest and taxes. Now if you look at the depreciation, which is deducted from earning before depreciation and interest and taxes, there is depreciation only for first 3 years. This is because the machine was purchased 3 years back, and depreciation has been counted for last 3 years. So here is the calculation of depreciation for the present or old machine of Pal Corporation. The present machine was purchased 3 years ago, and the machine was depreciated under MECRS 5 years recovery period. We know that if a machine is depreciated under MECRS 5 years recovery period, there will be depreciation for 6 years. So here is the depreciation calculation for the final 3 years. So after deducting the depreciation from earning before depreciation, interest and taxes, we get earning before interest and taxes. Then we deduct taxes. There is no cash flows for the present machine for the final year. Then once we deduct the taxes, we get net operating profit before taxes. Then we also again need to add the depreciation, as depreciation is a non-cash expense. So we are adding depreciation for the past 3 years. There is no depreciation for the final 6 years. And finally, we get operating cash inflows for the present machine or old machine over the next 5 years. Now, here is the incremental operating cash inflows for Power Corporation. So, this is the operating cash inflows for proposed machine, the second row, and the third row shows the operating cash inflows from the present machine. So if we deduct the operating cash inflows of present machine from the proposed machine, we'll get the incremental operating cash inflows for Power Corporation. So the final row shows the incremental operating cash inflows for Power Corporation over the next 6 years. So we have learned how to find out operating cash inflows. In our next lecture, we will learn how to find out terminal cash inflows.